It really worked well yesterday, actually.
It worked excellently well. That is the problem, right? If it was a mess yesterday, then I'd be so much more relaxed. Super.
Kosuke, thank you for joining us again late at night, even when you're not presenting.
Hello. Yes.
That's right.
Hello.
All right, so I guess we may as well get started. We're going to begin by learning about the foreign exchange markets. And Alain is going to start, and we're, I guess, going to have a tag team presentation.
All right, thanks. Thanks a lot. First, Jonathan, Rafet, thanks a lot for inviting us to do this. It's been a lot of work, but a lot of fun. And thanks for the organizers at Bilkent for making this work well. Thank you. All right, so this is a chapter on foreign exchange market. I'm Alan Chabot from the Federal Reserve Board. My co-authors are Dagfinn Rime at the BI Business School in Oslo, and Vlad Sushko at the BIS in Hong Kong. They're assigned to Hong Kong at this point. So we'll basically, as we discussed a second ago, Vlad and I will present this. We're saving the best for last in a sense that Dagfinn will then discuss the paper by Angelo, which comes next, right? All right, so next slide. All right, so overview what the chapter does. So it's a broad overview of a market, right? It's not about exchange rates. It's a chapter about the foreign exchange market, and it's specifically about the spot foreign exchange market. It spends time highlighting the current FX market structure and market ecology, who the players are and how the market works, which I think hasn't been really discussed a lot because it's changed a lot recently. It touches on a few so-called new topics. I'll explain. Internalization is one last look, and perhaps some less new, but still fairly new topics like the fixing and the fixing scandals and flash crashes in FX. The ideas for future research we cover are mainly about how the new market structure and ecology impacts price discovery, liquidity, information content. And I think the main challenge for us in writing this was trying to decide what to cover and what not to cover. It's a very broad topic. There's a rapid evolution of market structure. So we look forward to comments by Angelo and then other people about what we should cover, what should not, what's missing, what's not, what should be taken out. And importantly, we did seek input. We've talked to market participants, and we will do it again. We plan to run the chapter draft when it's a bit more ready by more participants to get their input, not necessarily because we designed the chapter for them, but because we think it's such a unusual environment now that we want to make sure people read this and don't roll their eyes, the guys that work in that field. Okay. Next slide. So briefly, the section of the chapter, first we start with market size and main players and introduction. We then spend time on the trading environment, old and new. We explain what the environment used to be because I think it helps to understand what the new one is. We talk about algorithmic trading, but that's mainly about the role of principal trading firms, also known as HFTs. Given the focus of the chapter, we talk about the role of the official sector briefly, mainly about regulation oversight of the FX market and FX intervention. And then we have a few special topics, specifically flash crashes, fixings, last look, we'll discuss this in a minute a little more, settlement and settlement risk, and then we get into the topic future research. We'll highlight this in a minute. So I'll let Vlad jump in now, and then I'll come back at the end.
Yes, thanks, Alan. So just to give us overview of the size of the market, it's about $2 trillion per day in terms of daily trading volume. And it's kind of been this way for the last few years. And compared to equity markets, it's about 4 times the global daily trading in all equity markets. So it's fairly big, but also quite concentrated in London, New York, followed by Tokyo, Singapore, Hong Kong. And market structure about 20 years ago could be depicted by this type of diagram, probably fairly familiar. It has a clearly defined 2-tier structure. In the outer tier, dealers and customers trade. And this used to have a form of bilateral OTC trading direct between dealers and customers using like telex or voice. And then in the interdealer market is the shaded part here. It was pretty big, about 2/3 of trading activity. And this is because a single customer trade could generate a cascade of hedging trades of inventory risk by dealers, so-called hot potato trading. Lions called it that way. And quite important for the hot potato trading was the advent of electronic brokers, which are organized as anonymous limit order books. And there are basically 2. One is EBS market, another one is Reuters Refinitiv matching. And they constitute what is called primary venues. EBS is where euro, yen, Swiss franc trade, and Reuters Refinitiv is a place for trading Commonwealth currencies like the pound and Australian dollar, Canadian dollar, with US dollar as the vehicle currency. Over the past 20 years, however, the market has undergone profound structural change. The share of interdealer trading has declined from about 2/3 to just 1/3 of the market. And whereas the dealer customer trading increased by about the same fraction. And the major driver for the decline in the interdealer trading is the process of internalization, whereby instead of going to the interdealer market to hedge inventory, dealers would temporarily warehouse risk arising from trade with one client until an offsetting client trade arrives. And this is now can be done efficiently because of the proliferation of electronic trading with clients. So in this way, dealers can avoid going to primary venues, so-called lit venues as well, where they'll be signaling their trading and can potentially result in adverse price impact, and instead use this technology to warehouse risk. This is the diagram we have to represent the current market structure. It's obviously quite more complex. The interdealer market, the shaded part, is now just about 1/3 of activity. And the dealer to client, the outer tier, it has now a variety of ways to execute trades where clients can access liquidity, mostly by electronic means, using platforms such as single dealer platforms, multi-dealer platforms, and also a variety of execution methods that we discuss in the paper. And another important development is the proliferation of initially the inner tier, but then also the outer tier by principal trading firms, denoted as PTFs in this diagram, also known as high-frequency trading firms. And this is quite an important development because it represents a shift in the structure of intermediation in the market. So we have one more slide to discuss this. Principal trading firms have essentially 2 ways of participating in the FX market. About 15 years ago or so, this was done primarily by being prime brokered onto interdealer limit order books, where they enjoyed anonymous trading in the inner tier, and combined with their speed advantage, they exploited a variety of high-frequency trading strategies. And Alan has a number of papers on this topic. More recently, about 5 years ago, maybe a little bit more, PTFs started engaging in the model of disclosed liquidity provision to clients. This means trading in their own name, direct price streams to clients. One way of having price streams to clients would be via some multi-dealer platform, but that is not the only way. And in this way, PTFs have now penetrated the domain that used to be solely that of dealer banks. And this is quite an important shift. In last year's survey, Euro Markets, according to their survey, Euromoney survey, PTFs, just 4 of them accounted for 30% of electronic trading volume with clients, which is quite significant.
So I'll jump in at this point. Thanks, Vlad. So here's a graph of the manual versus algorithmic execution on EBS market, one of the big clubs at the core of the market, which, as we've discussed, have lost importance but are still important, right? This starts in 2004, goes to the present, and the red line is manual trading, guys trading on the keyboard. The blue line are bank algos, that is computer trading but done by banks, and the yellow line is non-bank algos, that's a PDF and HFTs that we've seen. So years ago, when Jonathan and I actually started to look at this stuff many years ago, it was mainly manual with just a hint of algorithmic trading. Over the years, the share of manual trading on the keyboard has really just gone down a lot. And you can, what's interesting, if you look at the red line in 2020, there's a little dip down when COVID hits, actually. This kind of put an additional decline on the share of manual trading. But at this point, bank algos and non-bank algos have approximately the same share of trading on EBS, which is interesting. Now, non-banks, the PTFs, the HFTs, use both market-making algos and aggressive algos, right, to take other people's liquidity. The banks also use execution algorithms, right, of all kinds to execute the customer's trade electronically. Plus, they use some of the technology that PTFs and faster guys use, but much less. Next slide. So first, we want to give you, there's a lot of things in the chapter. We wanted to highlight a few, a couple of interesting things before we get into the specifically research topics we were discussing. So one is the interaction of the FX spot and FX futures market. The old literature on this, about old, I mean like 15, 20 years ago, said really that price discovery is really occurring in the FX spot market. Well, it may be changing a bit to some extent, right? Now, number one, the trading volume of the primary market clubs, as Vlad discussed, has fallen quite a bit. Also, the role of PTFs, the role of HFTs in FX has grown, and those guys rely a lot on correlation with FX futures to price FX spot. It's not just trying to take advantage of people who are a little behind the time, but their pricing engines really use FX futures to price spot. So there are claims, we've heard claims from market participants that FX futures now often lead FX spot in price discovery. And we've done some work, actually. You could do some Handbook VARs and see this happening to some extent, right? Interestingly, also recent flash events in this market, and there's been a couple of them, the British pound in 2016, the Japanese yen in 2019, show evidence of both the interaction of spot and futures and of the role of PTFs in FX markets. In particular, for the British pound event, if you look at very, very precise data, right, a trading halt in FX futures was precisely associated with the sharp degradation of liquidity in spot FX. And there are no trading halts in spot FX, but they exist in the futures market. In the case of the Japanese yen, actually, the flash crash occurred during the 1 hour of the day when FX futures do not trade. They trade 23 hours a day, not 24. And it's worth remembering that futures play a major role in price discovery in several other financial markets. German bonds, of course, where it's really the primary venue for price discovery, but US equities to some extent with E-minis, And US Treasuries. In US Treasuries, it's hard to tell whether it's broker tech or the CME futures, which lead price discovery, I think, these days. So is it possible that the FX market is going that direction? We don't know, but I think it's something worth watching. Next slide. All right, so another interesting topic, we brought the word that some people are still not familiar with. It's a fairly new thing, last look. So this is an extremely controversial topic in FX. It has an important impact on the market. I mean, I've seen people practically start yelling at each other about this, right, in the industry. It's interesting to see. So what is it? Well, it's a practice by which liquidity providers have the option to reject requests to trade on quotes that they have posted on some electronic platform. They have a last quote unquote last look. So you post a quote, some customer comes say, okay, I want to trade at this particular price. And you say, well, let me look at it. Let me think about it, see if I still want to do it. This does not exist on the primary clubs that we've discussed or in futures market, but it's pretty widespread, although not universal, on other electronic platforms, including single dealer platforms by banks and these multi-dealer platforms. So there's proponents of this and opponents of this stuff. They say the proponents say, look, we need protection against adverse selection driven by latency arbitrage because the market is so complicated and there's so many platforms and so many ways to access them. Therefore, doing this helps us to lower bid-ask spreads. And then we can also post liquidity on many platforms. On the con side, the people opposing this say this allows liquidity providers to take advantage of customers. You wait to respond to a trade, you wait to see if the price is moving in your direction, and you only accept the trade if it's profitable for you. And then they say, look, quotes with lower bid-ask spreads may not really be executable, right? So this is not a good thing for the market. So this raises questions in general, is non-firm liquidity, the last look liquidity, displacing firm liquidity in this market? Is this a step backward for market quality? Or is this a reasonable practice that you have to use, but use it properly in this particular market? All right, next slide. How much time do I have, Rafet?
Sorry, you have 1 minute.
Okay, sorry, very quick. All right, topics for future research. Market liquidity, we've said, okay, you've seen this. Is last look good or bad for this market? How bad is the liquidity mirage? But also, how do you measure liquidity given last look in the multiple platforms? Obviously, bid ask and depth are now less informative. Is price impact a better measure? Yeah, I think that's right. But that's an interesting topic. Price discovery in general, where, who, what, how. Where, we've seen it's not just on EBS and Refinitiv. We've heard that some firms now create a live composite reference price many times per second, looking at many platforms, right? Who is the question. Is customer order flow still important? Well, PTFs bring other information via correlations with other markets, right? So we have this idea of who is actually bringing information to the market. I think customer order flow is important, but there's other information getting in there. This raises question about what the information content of the market. We know that PTF impact on information acquisition along the lines of paper by Weller, for instance. Are they reducing information acquisition in this market? And how is are limit orders becoming more important than market orders in this market? Or how are they relating to each other? Next slide. I'll be quick on that one, Rafet. Other topics idea. All right, market design and IO. So what drives the evolution of the FX market? So it's interesting to see that the market has evolved with little or no regulation and oversight. There really is very little oversight and regulation, particularly on how platforms operate. So it's been endogenous creative. Speed bumps, for instance, have existed in this market since 2013, even way before they were considered, I think, or discussed in the equity market in the US. So how does a market endogenously choose where price discovery occurs? I think is an interesting question. And is this leading to a good equilibrium, or would it be better to be centralized? Could that explain the growing role of futures, right? That's what we're seeing. And finally, I think we have to discuss this. I know Bill English yesterday brought the impact of CBDC on central bank balance sheet, but is this a very old, antiquated structure? I mean, will the chapter be obsolete soon? Settlement is fairly slow in this market. It's T+2. Intermediaries have this unusual role, but given the new technology that we have, distributed ledgers, stable coins, in particular CBDC, right? Central bank digital currencies, if many countries or all countries have CBDC, will that change cross-border payments? Very probably, but could also make it change drastically the way the FX market operates in the future. I think that's going to be an area of research soon. All right, thank you.
Let's move to the discussion. Angelo?
Yes. Hi,
Very good.
everybody.
We hear you, we see your slides.
Fantastic. So thank you very much for giving me the opportunity to discuss this chapter. And it's an excellent work, of course, by three experts like Alain, Dagfin, and Vlad. So overall, I don't have much to say. So I have more suggestions than comments. First, the structure was pretty clear, described by Alain. Maybe what I felt a bit, it was a kind of back and forth with some concept, like last look was discussed in a given point, and then again after. I understand that the reason why they did so, but maybe you might want to consider to make it more the flow more smooth. My first suggestion is about, hey guys, why don't you discuss maybe the main contribution or innovation or advances in the FX literature, which is FX asset pricing, right? I understand it's an editorial decision to focus on the market rather than on the values, but on the other hand, I think it makes totally sense to discuss a lot, to dig into the FX market microstructure, but I would have hoped to see at least a couple of paragraphs about what determine currency values, right? Under some assumption, the FX value is given by future interest rate differential and risk premia, right? And then we had important papers recently investigating the carry trade or other pricing factors, including the US dollar factor. And also there was a new approach by taking the safe asset point of view and try to understand how the convenience yield, the liquidity premium, liquidity services of an important asset like, I don't know, US treasuries, for instance, can affect the FX rate. And then other risk factors, including momentum, volatility, on information asymmetry, risk premiums, and so on, right? So I found that you might want to think about that if you want to open the door to this. The second thing is the financial technology, right? Indeed, you discuss a lot the technological innovation like electronic execution, algorithmic trading, but maybe there is more. For instance, when I had the opportunity to discuss with FX traders or experts, they told me that nowadays algos, for instance, apply artificial intelligence to determine micro forecast and so on. So yeah, and second, the digital finance, right? I think you spend more time in the presentation rather in the paper. In the paper, there is just a parenthesis about how, for instance, digital currencies or cryptocurrencies might impact the traditional fiat currencies, right? The blockchain, also the settlement, the smart contract, or new market design that are growing in the cryptocurrency environment, like automated market making. I have in mind Uniswap here, for instance. Could this, for instance, apply to the traditional fiat currency? If not, why? And how it could affect that? That would be maybe deserve a little space in your chapter. Then the rest is just about small things that I will send you guys, maybe a typo rather than more a sharper way to say a sentence or two, right? It's not much here. I don't want to bother anyone about that. Okay, I think this is a great work, and I'm looking forward to seeing the final version, and I'm gonna recommend to everyone to look at that.
All right, super. If you unshare, we get to see each other and we have time for a general discussion. So who'd like to jump in? Let me begin, if that's all right. I have two bits actually. One is last look is something that I hear not almost exclusively in the context of FX markets. So I'd be interested in knowing whether that mechanism exists in other markets too. I mean, is this something invented only for FX trading, or do we see last look in at least on some platforms for, say, equities, treasuries, whatnot as well? And you know, if not, you know, why is the FX market special in this way? The other one is on the futures-driven price discovery. So this is something kind of understandable in some markets, in particular when the underlying market isn't round the clock. So in equities, it's kind of understandable that futures might be the place for price discovery because there's a period where the market is closed. But in FX, when the underlying is tradable all the time, is there any guesses on why is it that price discovery has shifted to the futures market? Anyone else? It's more fun when there are more voices. Okay, would the authors like to respond to some of these points?
Sure, I can. Can I jump in?
Please.
Angelo, thanks a lot for your comments. We'll look at particularly the ones you wrote down very carefully also. On the whether or not it was an executive decision or not to cover exchange rates, right? I agree that perhaps somebody reading the chapter would say, you know, okay, but what exactly is driving these things? I mean, so we have to decide, we have to let Rafet and Jonathan decide whether or not they want this stuff in there. But we specifically had a discussion. I had discussed with Jonathan before, and we decided to leave this out to some extent. Right? But let's. I agree with you. It maybe it'd be a better read, or people understand exactly what are we talking about here. What drives the price? It's important, right? But thank you very much for your comments, which are too kind. This chapter is not ready for prime time quite yet, but we're working on it. So hopefully it'll be good. Rafet, I want to touch on your first question about last look, right? So I spent a lot of time working on last look earlier this year with when I was working on the global FX code actually, and we had the same question, right? I mean, is this something that occurs elsewhere? I mean, there's a lot of OTC markets, right? Why not? And you know, we got a real variety of responses. Some most people said, no, this is something that's only in the FX market, and to some extent, it's true as far as being a wide open practice, right? There was a little attempt to start this in the U.S. Treasury market, where one platform actually said, okay, we're going to have last look, we're going to operate this way, but this didn't really catch on. On the other hand, I've had people tell me, you know, there's no official last look, but when you get a request you post a quote and somebody requests to trade with you, some firms basically do take a last look electronically, and we're talking about, you know, milliseconds here, right? I mean, 100 millisecond is a slow last look response time, and 10 is more like an average one. But some firms in their algorithms actually look at this and say, okay, yeah, the price has moved since I posted this quote. I just don't want to trade at this particular price. So we don't have a great answer in this. It's wide open. It's and openly discussed and openly, you know, done in FX. There could be little pockets of last look elsewhere in other stuff. It's considered bad form in other markets. It's not necessarily considered bad form in FX. Some risk article on this came out today. I think it really is a big discussion topic. Right? But your question is quite excellent. I wish we had a straighter answer for it.
All right. Thank you for that. And if there are no further points, we can move to the next paper, which is going to continue on FX, this time on the swap side by Angelo.
Okay, thank you. So that's my chapter on the FX swaps and cross-currency swaps. That's the way I structured the chapter. I have a pretty long intro where I define the two things, the two instruments, the FX swaps and the cross-currency swaps. I stress the difference between them. And then I talk about how to price them. And then I conclude the intro by mapping the FX swap market. Then I move to the institutional framework. Of course, I spend some time on the over-the-counter nature of this market, then the technological changes, the policy action, and finally I conclude them. And the third part is about research, what I would like to see in the future. Right now, the question, what I bring in as a novelty in this compared to a standard chapter in a handbook, and this is highlighted in red, right? So for instance, after the standard introduction of the contract design and so on, when I talk to the pricing, I stress the importance of valuation adjustment. The XVA, which is really key now in the market, has been common practice now. And every dealer essentially applies that, if not on its own, he delegate this service to a special company that does that and apply this adjustment. The second is the mapping. So I have tried to be innovative here by using more high frequency data rather than the lower frequency snaps done by the BIS and so on. I use the CLS volume data and flow data. In the institutional framework, I spent some time in looking into the electronic trading and the settlement environment. And then I also discussed the regulatory aspect that has been implemented after the global financial crisis. And of course, then the research part should be also pretty novel. Okay, so for the interest of time, I'm going to skip the classical schematic view of what is a FX swap, what is a cross-currency swap, and maybe let me tell you a bit more about the pricing. All right. So in the classical standard handbook, you rely on a idealized setting where there is no frictions. Frictions, I mean funding cost, regulatory issues, margins, the counterparty credit risk, and capital cost, shadow capital created by, for instance, regulation, capital requirement, liquidity requirement, right? But this is not the case. In the practice, you have them, and banks, especially banks dealers, apply this adjustment. The XVA, they adjust the benchmark value according to the credit involved in the transaction, the debit aspect, the funding, valuation adjustment, and margins, initial margins, possible margin variations, and capital requirement. All of this is taken into account, right? In the handbook, of course, in the chapter, I cannot really, discuss only this. I focus more on the CVA. But what I argue really is that all this created dispersion in prices, right? Because every bank, every counterparty demanded a different adjustment. Every jurisdictional implementation of a regulation also create indeed a heterogeneous pricing. And even if the contract refers to the same fundamental value, right? So that's my thesis that I try to highlight in the chapter. Then I pass to the mapping, right? So first, we show that it makes sense to use CLS data because they benchmark it with the BIS snaps, the cross-section, the market share across currency pairs is similar. And then what you gain when you use CLS volumes is that you have a more high frequency observations, and you can, for instance, look at the time variation of the swap volumes, right, in magnitude of the varies during the crisis and so on. All right, so and then what you can also do is to break the volume down to counterparties and to maturities, right? And this is already on the left-hand side, suggests you that there is a first difference between what Alain, Vlad, and Dagfin described in this for the spot market compared to the swap market. And this is the fact that the interdealer market is still very predominant in the FX swap, rather than in the spot market. It's been reduced, right? And second, the maturities, you can see that within 1 week maturity, you are really more than 50% of the market share. And this is, again, seems to be a simple fact, but there is a lot to study in this. What you can also look at, since when I told you this is high frequency data and an high frequency data set, you actually go down to the hour by hour frequency. So you can have also a look at the standard intraday patterns in volume and in flows in this market. And you see indeed what was discussed before, that the market has, yes, it's around the clock market, but yet in some hours, it's really illiquid, right? There is no essentially activity suggesting that the dealers close the book at a given point in time, and therefore we should expect some variation in price impact, transaction costs, and so on. Right, and also there is some geographical effect. For instance, of course, the yen, the swaps on the yen are more traded during the Asian hours and less so in relative terms during the London hours. This is another picture. It's centered around the IMM date, so the International Monetary Markets date. So when it's the third Wednesday of March, June, September, December, when many FX swaps and other derivatives expire, right? That's the blue area here, right? It's interesting to see that really the volume collapse at this point of the month, right? Rather than a quarter end. Right, and my prior was that at quarter end there was a drop in volume, but the key moment is indeed the IMM time. Okay, good. Then I move to the institutional framework. I discussed the two-tier market, which is less separated as before. There is indeed other financial institutions that are taking the role of broker over brokerage and market making function. And also there is more and more electronic trading venues. But if I can stress that compared to the spot market, this is the case, but at a slower pace. Then I discussed the technology, the electronification, the settlement issues, that I think it was an important improvement in the last 20 years, bringing multilateral netting, a reduction of risk by applying the lateral netting and improving the collateral allocation. Finally, I discussed the policy actions, and I focus on the post-crisis regulation. And I come back to the thesis that I told you before. I think this has brought price dispersion. And also I focus on the leverage ratio, Basel III leverage ratio rule, because in the recent literature, it was stressed a lot that this could explain the quarter-end effect. But on the other hand, FX swap is an off-balance sheet instrument, and it's not clear to me how exactly the bank dealer balance sheet is affected by the leverage ratio rule. And finally, I also spent some time on the central bank swap lines, but I'm sure the chapter by Ricardo Rice and co-author does better. But research, let me conclude. So first I stress that there is it's not much. It was difficult in the past to carry out empirical analysis about FX swaps because there was little data, but nowadays it's getting better because some at least can access repository supervisory data, and second, CLS data could also be used in the future. And then about the next research frontiers, I think we should understand better the market design. All right. There was important papers in the last years about over-the-counter market, and provide theories about that. But having models underpinning theory, how exactly the FX swap is designed and how, for instance, the central bank swap lines of unconventional monetary policy affect that would be really great. Second, asset pricing. So, of course, we know the interest rate parity, we know all this, but how the supply side affect the pricing, for instance, taking the XVA point of view of the asset or intermediary asset pricing point of view, and how the demand side, the pent-up demand for hedging, funding works. And finally, market microstructure. Price formation, price discovery process in this market are pretty unknown. There is much more to know about liquidity and also contract design, including the transition out of the LIBOR. That's all.
Sorry. All right. Great. And Dagfinn, I think, is going to discuss, right?
Yes. So you can see my slides and hear me?
Affirmative. Go ahead.
Thank you. So thanks for opportunity to discuss this very nice and interesting paper. I think, yes, I think it gives a great overview of the foreign exchange swap market. I learned a lot, and I especially liked the viewing the market via this new CLS data, because we really don't know that much about this market, and this definitely provide new information on the market. So that's very valuable, and I appreciated that a lot. So these are, especially FX swaps, is like a huge market, but so very important for international hedging and funding, yet there's very little research. So hence, I think this paper might be a very good reference for future research. So, I mean, all the papers here, they're going to struggle with the page constraint, and this was mentioned yesterday as well. But in light of sort of the importance of this market, yet little research, there's a need for more information. Hence, I would like more. I like what I see, but I like to know more about the market structure and institutions, and sort of just to look ahead. I would like to see a bit of sort of combining the BIS data with the CLS data. I think that's important. I think regulations and pricing is extremely important, yet as Angelo acknowledged, it's very complicated. So it would be good with a bit more discussions. Might be difficult, as I said, but as Angelo acknowledged, there might be scope for shortening maybe the central bank swap line part. Okay, so let's sort of dig in by sort of begin with having a look at the market, and I do that by using the BIS triangle, and I think this might be illuminating. So these are daily trading volumes in billions of dollars, and the blue line is FX swaps, and reddish is FX spot. So first comment here is that I maybe would like to see a bit more discussion in the paper of whether FX swaps really is FX, or if it's a interest rate funding type hedging instrument. You don't take FX risk as such, and it feels a bit more like a funding instrument to me. It might be sort of semantics, but I would like to sort of see more of a discussion than sort of a quick conclusion on this. So as we see, FX swaps have continued to grow and is now more than $3 trillion daily in 2019, which this continued growth is kind of different from what Vlad showed for FX spot. So there for spot it's sort of leveled out, while continued growing for FX swap. I think that's really interesting. Maybe something related to since 2013 how international participants use FX swap for funding. Another comment here. So we see the triangle has FX swaps above 3 trillion, while the CLS data are 1 trillion approximately. So it's one third. So it would be interesting to sort of see a discussion of that. And that's also why I sort of believe a combination of BIS and CLS data will be valuable, because there are issues with the CLS data, I think. Sort of continue a bit then on BIS data. So this shows the counterparty shares from the BIS data, and Angelo commented on this. So BIS data, they have 3 groups. They have dealers trading with other dealers, dealers trading with non-bank financials, and dealers trading with non-financials. And since it used to be a very two-tier structure with dealers as the prime liquidity providers, this sort of dealer-centric view is still very important in swaps, I think, less so in spot. I think some comparison to spot is useful and might help us, because it's sort of basically 2 international OTC market, and we know quite a lot of spot, but a lot less about swaps, and sort of the comparison is interesting. One thing I find very interesting here is that this sort of trend to less inter-dealer trading stopped up and say 2005-7. It's probably 2007 that kink. And then sort of level off. So it continued to be a lot of inter-dealer trading. And I think that speaks a lot to the potential for electronic trading in FX swap markets compared to FX spot. In FX spot, inter-dealer trading is now 1/2 of trading with financial customers. A few more sort of comparisons that we can get from the BIS. So while almost 40% was an average over 2013-2019 BIS triennial was prime brokered, only 7% was prime brokered for FX swap. So that's sort of reflecting that less participation by financials in the inter-dealer segments, and less scope for it probably also. So trade sizes and trading frequency and how they conduct trading is quite different. So trade sizes are huge, while sort of back of the envelope trading frequency, it's a lot slower for FX swap. So that sort of speaks a bit to the scope for example, limit order trading in FX swaps. So it's quite active market for overnight, but for longer maturities, less and less active. Sort of discussing this would be sort of very interesting. So on the microstructure part, I think it's important for future research not to sort of simply follow on and believe this is like an FX spot market structure. It's quite different. And I think this paper would be very valuable in sort of informing future research about these differences. So I think it would be very valuable if we could discuss a bit more on who is trading FX swaps. So that's difficult because we lack data. But to the extent that Angelo could have a bit more on how different market participants use swaps and how they do hedging, that would be very valuable. I think, as I already said, using the BIS triennial as an overview of the total market, but then we can use the CLS as this high frequency, and was very great fun to see this sort of intraday breakdown. One comment there is that I wonder what's happening with the euro dollar number at the 8 o'clock GMT. It was like a very sharp spike there. Also, this figure number 7, it's almost like a research question in its own, because I had the same prior as you, Angelo, that the volume would drop off at quarter end. So I wonder about the relationship with future markets, because these are not sort of following the ordinary IMM dates. So that would be interesting. Is it some kind of hedging, or is it because of sort of when this is issued at new, there's something on demand side. Okay, regulation.
Det vet jeg ikke svaret på.
Sorry.
Det noe annet jeg kan hjelpe deg med?
Siri is sort of doing something strange there.
You should take another 2 minutes, but not more.
Yes, regulations. So we know that there is sharp deviations around quarter end, and especially year end. Sort of in light of these are CIP deviations for 1 week LIBOR, that there were not deviations prior to global financial crisis, when there was not a leverage ratio imposed, but a big deviation after. Sort of seems tempting to say that leverage ratio is very important here. However, so this is a comparison where we do the same CIP deviation using 1 week repos. This is for sterling. So we see that there were deviations no deviations for LIBOR, but deviations for repo, even and of similar size, even prior to 2008. So the linkage to LR regulations, it's not clear at all, I would say. So on pricing, I think how pricing goes on and sort of prices are adjust and how they react to order flow, this is microstructure, is important both when there's no deviation, like in an ordinary market where things are basically pinned down by no arbitrage, and also when there are deviations. And when it's deviations, I think there's more than just the regulations. The XVA discussion is super interesting, but I wonder about the importance for interdealer trading, which is very short maturity, and typically between banks which are sort of same quality, and there are two-way credit support annex, sort of continuous margining, making both the sort of probabilities and sort of the expected defaults so small that I'm not sure these XVA's adjustments are that relevant. Just a fun fact, forwards are known to be priced off the FX swap. So there's very little interdealer market for forwards, but those are sort of priced off from the swaps. So the swaps are really important also for the forwards that many, say, non-financial corporations are using. So just to sum up, I think it's a very interesting paper. I think it must be challenging as there are little research, but that also makes it more valuable for future research as a reference. And we have some more comments that I got also input from Alain and Vlad, and send those other comments directly to Angelo. But thanks a lot, a great paper.
Very good. And we can move right ahead to the general discussion. Andreas.
Yes, thank you. So just one comment and then a question. So one comment is about the maturities of the instruments. So, I wasn't so clear, Angelo, from your presentation, how you look at this maturity dimension there. I mean, and I'm saying this because the different players that are operating in different segments can be quite different. So, I mean, in the short end, you will have a lot being driven by money market players, and including the central bank, of course. Whereas then at the longer end, for the cross-currency basis swaps, it will be an entirely different set of participants, in particular real money investors, and then also maybe insurance companies, etc., that will affect the developments. And this also applies to the relevance of the XVA, which, as far as I know, and consistent with what Dagfinn says, is less of an issue for the short term, but it is an issue for the longer term. So it really matters, the maturity dimension. And then my question is about, you had it on one of your slides, that cross-currency basis swaps now have new pricing conventions with SOFR and SARON and so on, the new reference rates rather than LIBOR. So I would just be curious if there has been a smooth transition in this regard, how the volumes are picking up, how that is overall changing the fabric of the market. I think you have a great opportunity now to cover this very interesting transition that is taking place pretty much right now, away from LIBOR, and it affects this huge FX swap and cross-currency basis swap market. So some details on that would be great.
Okay. Angelo, do you want to take a minute?
Look, thank you very much to the discussants, and also to Andreas for this. He brought up this point. Look, we have a research agenda for 20 years. Yeah, let's try to do all of this. But yeah, indeed, there is All these are good points. Maybe the XVA in the interdealer is true that it plays a small, but it really depends if the dealer to dealer position is balanced or unbalanced. If it's unbalanced, I mean, after netting, then I think XVA could play an important role. If it's instead we can net our position, and of course the counterparty risk is not that much and so on, I guess, especially nowadays that things are centrally cleared. Of course the XVA are smaller. Okay, thank you very much.
So
yes.
before I let you off the hook, let me read you a question on the Q&A. In terms of models for trading spot FX and FX swap contracts, what do you think about the role of international portfolio rebalancing practices?
Good question. I think what we have seen on the IMM time, that could be, for instance, one driver, right? Positions like that are rolled over during those days could create this kind of volume seasonalities and that. Yeah.
All right.
Yes.
I'll actually let you ponder this a bit more and move to the next paper. Salim is going to present, right? Who is muted but is talking.
1 second. Yeah,
All right.
Present. Thank you. Should I just share my screen?
We hear you. We see your slides. We're good to go.
Let's get into full screen mode. Yeah, that's all good. You can see, and it's scrolling. Perfect. So thanks a lot, Rafet and Jonathan, for the invitation to myself and Ricardo for this chapter. We really enjoyed putting the paper together, and I've learned a lot from the conference so far. So thanks a lot for letting me be here. So this chapter is on liquidity lines between central banks. We unilaterally changed it from swap lines to liquidity lines, just so we have an opportunity to talk about repo lines as well. So we just redo things a little bit, but I think that's in everyone's advantage to change the mandate that we had slightly. Okay, fine. So time is short. I'm going to jump in and quickly explain what we mean by these liquidity lines, and then I say what I'm going to do in the chapter. So these are essentially collateralized loans between two central banks, and I'll refer to the lending central bank as the source central bank, and the borrowing central bank as the recipient central bank. This loan is typically denominated in the source central bank's currency. It doesn't have to be, and we have examples of, say, Asian central banks lending dollars to their counterparties in exchange for local currency when doing reserve sharing, for instance. So it's not the case we have to have a matching currency with the source central bank. Another feature is that, as I said, they're collateralized, and that collateral sort of separates out these two different types of lines. So the collateral can be a deposit of the recipient central bank's currency, in which case, kind of superficially, this is structured as an FX swap, and we have a swap line, or it can be that the recipient central bank deposits some securities at the source central bank, and then we have a repo line instead, like we see with, say, Eurep or FEMA or some of the ECB's bilateral lines. These are less common. We have more swap lines, but they're functionally similar, apart from the collateral that's pledged. In modern usage, these lines are typically used to enable the recipient central bank to run a liquidity facility denominated in source currency for commercial banks in its jurisdiction to borrow. So that's sort of the current usage. Historically, they've also been used as a tool to manage exchange rate pegs. That's sort of fallen out of fashion more recently, although there are a few swap lines still lying around which have this exchange rate management role. Okay, so what I'm going to do in this talk is first give a brief history, which will allow me to discuss prevalence today and some of the issues we have regarding the size of the network. Then I'll discuss basically how these things actually function. I'll go through a diagram and explain how the swap lines function, or liquidity lines function, and I'll be able to sort of describe the economic effects as a result. And lastly, I'll talk about some lessons. There's more in the paper. I won't have enough time to go through all of them, but I'll discuss many lessons for policymakers today in this talk. Okay, so in terms of history, so actually, when you go back and read about it, central banks have been into money for a long time. I found sort of citations or evidence back to the 19th century of loans taking place. And we sort of know from, say, Van Green's work that the classical gold standard relied upon lots of cooperation and lots of exchanging of common resources being shared between different central banks. However, operationally, I think the current arrangements that we have, particularly in terms of them primarily being structured in swap lines, the facilities being standing, they really date from the Bretton Woods era and from the 60s and 70s. And what I'm plotting here is just the network of Federal Reserve swap lines as it stood in 1970, and the bubble size is the size of the outstanding balance by central banks. And sort of the classical explanation for why these swap lines existed was that they were a tool to provide liquidity to fund FX interventions and therefore support the fixed exchange rate regime. Another use basically was that the US was a current account deficit economy at the time, and the swap lines were basically a mechanism to provide dollars to counterparties abroad to prevent outflows of gold from the US, again to stabilize the fixed exchange rate regime. There's been other work on these and sort of a re-evaluation recently. So Macaulay and Schenck, whose data we're using to produce this picture, have some evidence that actually these lines were also used to stabilize offshore dollar funding markets as well, which maps more to the covered usage that we see today. So actually these historical lines also have a parallel with more modern facilities. And actually, these lines were heavily used too. So if you look at sort of the value of drawings compared to nominal GDP in the US, the share is sort of similar to what we saw in the COVID period. Okay, so this actually was a big policy back in the 60s and 70s as well. Okay, now once the Bretton Woods era ended, these transatlantic lines were discontinued. They were stopped in 1998. The Fed maintained some swap lines on the NAFTA, but what we also see was the emergence of new lines in Asia. And these were the response to the Asian financial crisis. And what happened was Southeast Asian countries agreed to start pooling their reserves in order to boost resources to fight off future balance of payments crises. And they structured them as sort of as bilateral swap agreements. So one country would swap their reserves for the other country's local currency in order for that country to have more resources to fight off speculative attacks. But still, these facilities had the motivation to sort of support FX interventions. And then things changed over the next sort of decade, starting 2001 really, but really picking up during the financial crisis, where we have a situation where global banks were heavily investing in cross-border positions. They all had typically large dollar-denominated assets on their balance sheets. And when money markets in the US shut in response to the crisis, finance business became very hard. And the Fed responded by establishing a number of swap lines with major counterparty central banks. And that enabled the central banks to then run operations denominated in dollars to provide the lost dollar funding essentially during the crisis period. And that pattern repeated itself again in the COVID pandemic, and the global network sort of grew dramatically over the 10 years from 2010 to 2020. And what we also see today is first a big network centered around the Federal Reserve, but also regional networks where the ECB has a set of bilateral swap and repo lines with countries in Eastern and Central Europe. The Bank of Japan has yen-denominated lines with countries in Asia. And actually also the biggest node in the network, the most connected country is China. And the PBOC has established actually 38 liquidity lines with various countries in the world. These have a different motivation again. They're not about stabilizing sort of the financial system so much. It's not the case that foreign banks have large RMBs denominated positions. Instead, these are used to basically support trade finance and internationalize the RMB. And there's some evidence of those swap lines having that effect. So what's interesting about this, and I think an open question in the literature is, is this network somehow optimal? This spaghetti we have on the map here, does it actually make sense in the sense of providing liquidity the international financial system needs? Are some countries excluded that shouldn't be? Are too many countries included? Should there be a role for some multilateral institution like the IMF or the BIS in coordinating facilities, as there was historically? I think that's an open question, and we haven't got necessarily to the bottom of it. One other interesting feature, though, of COVID was the establishment of FEMA and Europe. In Europe, and there were actually facilities that aren't bilateral. So many central banks in the shop at these facilities and get dollars or euros in a repo transaction from the ECB or the Federal Reserve, so long as they have the adequate collateral. And that sort of expands the network to most of the world effectively, given collateral constraints. Okay, so that's the history. Let me discuss very briefly how these liquidity lines work. I'm going to give the example of the ECB borrowing from the Federal Reserve, as that's the most commonly used transaction. So what happens is that the ECB will ask to activate the line. It will request a certain amount of dollars from the Federal Reserve, and the Federal Reserve will then has the right to approve it or not approve it. If it approves, it will transfer the dollars into the ECB's account. That's the loan taking place. And the ECB then makes a corresponding transaction of euros into the Federal Reserve's account. And these two transactions are done at the spot exchange rate. The euros just sit there, basically. They're supposed to be effectively the collateral. The Fed never withdraws them, it never spends them, and also doesn't get charged any interest for them. The ECB, however, pays interest on the loan the Federal Reserve makes it, and that interest is set at a spread that the Federal Reserve controls over the OAS rate in the US. Now, the reason why the ECB actually requests this money is because it wants to conduct a dollar repo operation for the Eurozone banks. That's the sort of second part of the transaction. So a Eurozone bank will come and say, I want to borrow dollars. It will pledge some collateral in response. And what's interesting about this is that actually it's the ECB that really controls the terms of the operation. It determines which banks are eligible. It determines what the collateral criteria are. Obviously, it's not going to charge a lower interest rate than the Federal Reserve sets, but it has a lot of control over how it's going to manage that dollar repo operation, which is interesting from how this policy is managed. And it presents actually some coordination issues across central banks, which I can come on to. And then the final step, the Eurozone Bank can then use that money for a variety of different purposes. It can capital withdrawals, provide credit to clients, buy dollar securities. And actually the evidence we have from literature on the swap lines is that all three things are used. There's actually some evidence that the credit can spill over across borders. So we have evidence that Eurozone banks borrow from the swap line and lend it on to their branches abroad. So the swap line sort of funding spreads out across the whole world. There's some nice Korean data showing that. And also it can spill back to the US as well. So providing the dollar to European banks can alleviate funding conditions in the US. And we also know, I mean, my work shows this with Ricardo, that the banks will purchase dollar securities and actually inflates the asset price of those securities as well. Let me just discuss very briefly what the PBOC does as well. So this is a slightly different setup, only in a couple of senses. First is that PBOC is providing here liquidity for trade finance rather than to support the general banking system. The actual transaction, I've done the Bank of Korea as the examples, the common use of the PBOC's facilities for trade finance. This actual sort of swap transaction is very similar, but we have an offshore clearing bank intermediating it. That's the sort of capital controls in China, kicking in, and that's why we have this extra block here. But what's the other difference is that actually this is used for a specific purpose. It's providing trade credit. The Korean bank borrows to provide an RMB loan to a Korean importer and to make a payment to a China exporter. And one natural consequence of this is that obviously the trade can be denominated in RMB. So you sort of naturally encourage the international use of your currency. By doing that, it also has the effect of plugging in the Korean banks directly into the RMB payment system. So that also boosts the use of the RMB. And from the trade literature, we know that if a particular good is used as an input and it's almost in a certain currency, then also you have an incentive to price your exports in that currency too, and that can boost the use of the currency. So that's what the PBOC is trying to achieve with its swap lines. Okay, so just to that's the setup. Let me just explain and how this fits together in terms of the properties. So what's effectively happening here is that the central bank, or the source central bank, is providing liquidity assistance to a foreign bank using the foreign central bank as an intermediary, right? It's doing the monitoring both of the banks that are borrowing and the collateral that's being posted. It's the source central bank's monetary base that expands, not the recipient central bank's monetary base. That just sort of sits on account somewhere. There's no FX or interest rate risk involved here. It's the recipient central bank that bears private credit risk. The source central bank actually bears the sovereign risk. And that's the sort of difference between the repo line and the swap line. In the repo line's case, we're going to go back a second, rather than the money being held on account here at the ECB, the ECB would have to put some securities in the Federal Reserve instead. So that would obviously reduce the risk to the Federal Reserve in the event of default. And when we first started working on this, we sort of thought this makes sense. It fits the basic function of central banks. It's the source central bank that's best suited to provide liquidity. Okay, I mean, obviously the ECB could find a way of funding its dollar repo operations by itself. There'll be some costs to doing that. I mean, bearing that cost doesn't make sense. The Federal Reserve can do it for free. Whereas it is the recipient central bank that's best suited to do the monitoring. Okay. Now, what is sort of the fundamental problem here? Why do you do it in this way? Well, fundamentally, there must be some sort of segmentation between borrowing costs in offshore and onshore currency markets. Right? That's sort of the fundamental idea. We need a security facility to break this segmentation. I don't think we know exactly where it comes from. There's various ideas and literature and theories, but the relative importance of them is not necessarily determined yet. Empirically, it could be due to information problems, regulation, legal restrictions. That's not obvious. But one thing we know that these facilities do is essentially put a ceiling on these offshore borrowing costs. And a particular measure that we focused on is deviations from covered interest parity as this measure of how these two costs of borrowings are deviating between offshore and onshore borrowing costs. We also know that, as I said, having a swap line encourages currency use. As a result, we have from literature, it generates capital flows into assets denominated in the source currency, and it also raises the valuation of the banks that have source currency assets that have access to the liquidity line. So it boosts their valuation as well in equity markets. Okay, and I want to end. I guess I have minus 1 minute.
1 minute.
Minus 1 minute. Yeah. Let me just say a couple of things on my lessons for policymakers. So basically 3 things. First is that actually there's a lot of inconsistency across these basically dollar repos that we see across central banks. So the ECB will have a very different collateral criteria than the Bank of England or the Bank of Japan, or indeed the Federal Reserve. Okay, so we have situations where multiple central banks will be lending dollars, and they're actually not consistent in terms of the collateral they require. It's a question of is that a problem? Is there some arbitrage opportunity arising? And should those opportunities be corrected for and some harmonization be imposed? A second issue is that we do see spikes in the costs of offshore funding when these repos don't take place. So these are scheduled operations. DC will have operation every week in normal circumstances, and between those operations you see spikes, and like naturally one way of fixing that is to have a standing facility, which seems to be feasible under the terms of the contracts. And the third point, just to wrap up, is that many of the lines that we do have are not fully fleshed out. They're like agreements in principle. And I think the market probably benefit to have the terms set out in advance, so we sort of know how they will actually operate if the need arose. Let me stop there. Thanks, Rafet. We're running over.
Super. Thank you. And I will provide the discussion. So let me share my screen. There you are. And I assume we hear me and we see my slides. So let me go ahead. Okay, so this is a great paper. The word that came to my mind when reading it was delicious. That's the kind of paper that makes you say, oh, this is why I became an economist. So thank you. It's like, chock full of information, extremely well written, as expected. It's kind of on the longer side, and I'm saying this as an editor. As a reader, I was happy to read it. And I don't have very good comments on where to chop. It was just a pleasure to read, but we'll have to think about chopping a little bit. So I have some suggestions, and these are obviously based on the paper, not the presentation. And in fact, the presentation emphasizes some bits that I wanted emphasized better. In the sense that when Jonathan and I commissioned this paper, there was a paper on central bank swap lines, and the title changed to Liquidity. It's, I think, a well-done change on two fronts. One, it broadens it into covering the repo facilities too, which should be covered under the same title. But more importantly, it correctly titles the facilities, that it makes it clear that these are not swap lines in the sense that we think of swaps, right? And in fact, even if we didn't know swaps, over the past 2 days, we've seen a paper on interest rate swaps and a paper on currency swaps. We kind of did understand what swaps are. And based on that understanding, it's very clear that these are not swaps, because in a proper swap, both parties want what each other have, right? They assign some value to the thing that the other party has. And here, when the Fed and the Swiss National Bank go into a swap, the Swiss National Bank clearly wants the dollars, and the Fed has no use for the Swiss francs. So it's clear that these are swaps in name only, but are actually loans. And when they are repos, they are properly collateralized loans. When they are swaps, they're actually kind of crappily collateralized loans. And that point, when you read the paper carefully, comes across. And I'd be happier if it came across more loudly, so that even the careless reader actually correctly understands that this is a way of letting the Fed lend to these other central banks without having to call it lending and defending such lending to the Congress. No? Okay. The other thing that I thought I should have thought of before, but this paper made me think, but didn't quite say, was the symmetry between the creation of the Federal Reserve System itself and the reason why that network of central banking was created in early 20th century and this current line of swaps, right? In the sense that when you read about the creation of the Federal Reserve System, before it was decided that it was to be a federal system, right? The call was to have a central reserve, a reserve. Then the reserves are, the reserves that we talk about today, but the central is a central holder of liquidity that is going to provide reserves to whoever needs it against collateral, right? And this is exactly what is going on here now. In effect, properly turning the Fed into the global central bank, being the central reserve of dollars, that is the global currency, and making those dollars available to, in a sense, branches. Right, and it's really instructive to think about this from the lens of discount lending. How to make use of those reserves was and still is decided by the regional Feds, exactly like how to make use of those swapped in dollars. The use of that is decided by the national central banks, and just like the regional Feds, especially early on, greatly differed in their preferred practice of liquidity provision, right? And this is Bernanke's early work that showed, the reserve districts that were governed by tougher reserve banks had worse Great Recessions. It's very similar that central banks swap these dollars in, and then they get to decide whatever they want to do with it. So that symmetry, I think, is very enlightening and is worth emphasizing here. Okay. The other thing is the paper has a very short bit on, I call this EM, but it's Argentina, that has swapped in currency from China for liquidity, trade, whatever, for proper purposes, and then used it for propping up its currency, right? Now, this is discussed as an exception. I think it's going to be much less of an exception in the EM world, because EMs did not need this kind of propping up in the era of very wide liquidity around the world, right? But once liquidity begins to dry up, we are going to see a lot of EMs that have access to these swap lines, swapping dollars in to be able to prop up their currencies. Now, this is me, the Turkish economist, speaking, and that's a big deal because we've been doing this to a huge extent. In particular, one of the things that is important, and that's going to be the last thing that I'm going to say, is the accounting of these swaps is such that the two legs are treated differently, right? The currency you swap in, that's on your balance sheet. The promise that you're going to reverse this, that's off balance sheet. And conveniently, you report all of your foreign currency holdings as a central bank in dollars. So nobody asks you, okay, you told me you have so many billions of dollars, but are these actually dollars? Or are you swapping in currencies that are not really even marketable, right? And pretending that you have reserves. This is Turkey. The central bank will tell you that they have $130 billion. If you do the accounting, they have minus $40 billion. Okay, and that, I think we're going to see much more of that. One of the more important bits here is my colleague Sang-Seok Lee, in a paper that kind of involves me too, showed nicely that the market rewards debt finance reserves. That is, the impact of reserves on the borrowing premium countries pay for many countries is larger than the punishment for having too much debt. So I don't know why this is the case, but it is the case. And therefore, it makes sense to borrow and pad reserves, right? So we're going to see much more of this. And I think there is scope in this paper to make that point, okay? One bit that I would like to see more of is the paper, I think, rightly ends with a call for more research without saying what it is that is to be researched on this topic. So some guidance by the experts on the field on that would be most welcome. But again, thank you very much for a great paper. And with that, we turn to the floor discussion. And as expected, Bill English has a hand up.
Yeah, my question, and sadly, I'm not going to help with the fact that the chapter is too long and the editors are going to be trying to shorten it, because I'm going to suggest another topic that is of interest, at least to me, which is how do countries decide on who they will have swap lines with? So I just remember a lot of fraught discussions at the Fed over this country and that country, and who do you want to have on the list and who do you want to have not on the list? Those are hard policy questions. And I'm not sure how much you can say, but it might be interesting to think about that. And also, it may be very different for China, for example, than it is for the United States. So thinking about who you're willing to have a swap line with might be an interesting question.
Super. Although we could ask Bill, right? You were there when these things were first being instituted. So presumably, you actually know the answer to your question. Any other comments on this paper? I turn to the authors if they might want to make some comments on my comments or Bill's comment.
I can answer the question, Salim, and you. Okay. Perfect. So, Bill, three ways to think about it. One is this counterparty risk, right? And so, and I think that drove a lot of it, which is the extent to which the other central bank, you can rely on them on paying you. Since, like Rafet said, the collateral here isn't great, especially if there's a lot of exchange rate volatility. So there's that one point. But here's two other perspectives that I have found at least intriguing in my mind, especially as Salim has explained them to me. One is you may look at the current arrangement and from a perspective of just access to liquidity, see a lot of holes in the network and worry. But you can look at it differently from a perspective of prices and think, well, what these do is put ceilings on CIP deviations on cross-currency basis. Well, because those transactions can be triangular, all you want is to look at the network of the world. And yes, in the, I don't know, some country, now I forget which one, will have a swap line, maybe Poland has a swap line with ECB, but not with the Fed. But the ECB has a swap line with the Fed. And therefore, by the logic of triangular arrangements, that actually puts implicitly a ceiling on the CIP deviation between that currency and the Fed. And if you do that and apply a little bit of network analysis, actually the current network already reaches hugely just because of, if you do the two legs and think about the effect on prices. So even if not on liquidity, certainly at least on prices, you end up with actually quite a remarkable amount of coverage. So anyway, that's something intriguing that once you start thinking about it, in terms of the arbitrage relations, you're actually already covering a lot of the world just because of the two poles in China, in the US, and the fact that ECB is at the center, having a swap by both China and the US. And then you combine that, and you actually end up with a lot of the world already covered.
You said 3 things.
Want to take a minute?
Okay, yeah, sure.
But when I say a minute, I mean a minute this time.
Yeah, sure. Okay, fine. So let me just say quickly on Bill's point. I think the choice actually also is, do you have a swap line or repo line? Because the Fed's already said we have BMO, and that's the world almost, right? So you've said, okay, BMO is there. If you're special, you get a swap line. I think that's good. That's the decision that's been taken. On my first point, I'll just respond very quickly on your first point. I think the Euro system is another example, and we discussed Target 2 yesterday, but you could describe Target 2 as a swap line as well, if you wished. And that's the same principle and same idea, although the facilities are coordinated, obviously. On your point about on debt finance reserves, it's not just Argentina, it's Pakistan, it's Egypt. With the PBOC, they borrowed money and done this in the same way. Argentina probably is the most blatant of the users. I think the IMF and the World Bank are trying to stop this, is my understanding, and change the rules for reporting. I'm not sure where they got to, but that's my understanding of what they're trying to do to prevent countries when addressing in this way via swap lines. Okay, I'll stop there. I'm out of time.
Super.
Thank you.
Thank you again. And we can move to the next paper, which is non-bank intermediaries. And people here might be wondering, whatever happened to banks? We commissioned a paper on banks too, but it didn't make it to the conference. So we'll proceed to non-bank intermediaries.
It's thanks, Rafet. It's great to be with this group. This is joint work with Siri Aramonte and Andres Group. The focus is going to be on non-banks, obviously, but with much more of a perspective on liquidity risk, and in particular from a systemic perspective. So let's start with a very stylized in a map like this. We have investors on the right-hand side. We have ultimate borrowers on the left-hand side. Money flows from right to left. And typically, the focus tends to be on the broker-dealer sector. The broker-dealer sector, which are mostly bank-affiliated, are very much viewed as the intermediaries that are at the center of non-bank finance, the non-bank intermediaries. And indeed, that was the case over a very long time. So the left-hand panel is from the flow of funds. We're going all the way back to 1954. And suppose we just map out the total size of 4 sectors: household in red, broker-dealers in blue. We have the non-financial corporates in black and commercial banks in green. And up until the eve of the great financial crisis, the broker-dealer sector had grown, something like 100-fold relative to the other sectors. But since then, you can see that it's basically stagnated in terms of total assets. If you look at leverage, which is the right-hand panel, and we're just looking at the period, the last 30 years, 1990 onwards, leverage really comes down after the crisis, and it has sort of continued to come down. So if you were to look at this, if you were to look at these charts, you might think, you could be forgiven for thinking that market-based finance is in headlong retreat. But of course, we know that that is not the case. And so, it does, set up, I think, a very interesting set of questions. And what we do here is to think about this in a systemic perspective, and also bring in perhaps the most important innovation, since the GFC, which is the role of platforms, exchanges, and CCPs, as well as the conventional market intermediaries. And if you take away one message from this paper, this should be it, which is that the domino model of cascading defaults gives us a very misleading picture of systemic risk. So this is how the domino picture spins the story. It says A has borrowed from B, B has borrowed from C, then A takes a hit, and if the hit is big enough and it eats through the equity, then B takes a hit. If that hit is big enough, then C takes a hit, and so on. So this is a kind of story of propagation of defaults through interconnected balance sheets. And I think this is the kind of first story that we would reach, to if we were to, try and speak to a journalist, for example. Now, the message in our paper is that if you want to think about liquidity risk, and in particular liquidity risk, even in the absence of default, and as we know from last year, even in treasury markets, we had quite acute liquidity stresses. We have to understand how risk propagates through the willingness to lend. And this is a chart that compares three different ways of increasing leverage. The first here is the mode 1. This is the MBA textbook picture where the assets are fixed, but you buy back equity using a debt issue. So you just see a compositional shift in the liabilities. So here the gray boxes mean that that part of the balance sheet is held fixed. The second mode is the kind of story where you sell assets and you pay yourself a big dividend. It's also the kind of Merton model where there is long-term debt, which is fixed in notional value, but the assets are varying. And there it's through the fluctuations in the size of the assets that you have changes in leverage. But for NBFIs, it turns out that neither of these two are the relevant ones. It's the third one, which is the relevant one. And this is the idea that leverage is mostly about margins. And you increase leverage because there is an increase in margin. So you go from the left-hand balance sheet to the right-hand balance sheet because the margins decrease, and so you can hold a larger balance sheet because of that. Now, why do we know that mode 3 is the correct picture? Well, let's look at it from the point of view of the broker-dealer sector itself in aggregate. So this is just a scatter chart from the broker-dealer sector. The horizontal axis measures the quarterly change in total assets of the sector. And the vertical axis measures two things. So you ask how much of the change in assets is reflected in the change in the debt, and how much of the change in the assets is reflected in the change in the equity. And the hollow blue circles here is the relationship between the change in the assets and the change in the debt. Actually, we've lost the regression equation here, but you can see from the line that the slope is 1. So there's a dollar for dollar change in the assets as there is a change in the debt, whereas for the equity, the line is flat. Okay, and that's exactly what mode 3 says. It says if you want to verify that the change in leverage is mostly about changes in margin, what you need to verify is that in dollar terms, a dollar change in the assets is reflected in the dollar change in the debt, which is exactly what you had in this third balance sheet. So what does this approach actually entail? So what we do in the paper, and I won't go through the derivation, but there is a derivation in the slides, and we'd be happy to share the slides. The approach is to say, think about the allocating margin, just like a consumer choice problem. There's a fixed amount of own funds that you have available, and that is deployed in holding assets of various kinds. And essentially, your leverage is really about how much, assuming that the margin constraint binds, how large is your balance sheet in that context. And let's track how the system changes as the margin constraint becomes loose or tighter. There are basically two propositions that come out from this analysis. And the idea is that the first proposition is that debt capacity of the system and of the individual participants has this recursive property where debt capacity is increasing in the debt capacity of others. In other words, leverage enables greater leverage. And the intuition here is that if your margin constraints are falling, it means that you can hold notional assets that are larger, but those notional assets in turn embed leverage. So there's a kind of you're actually powering there's a margin impact that is rippling through. The second key result is that the deleveraging stresses that we see and the dash for cash, where it's a kind of portfolio composition shift from riskier assets to safer assets, are really two sides of the same coin, rather than being two distinct channels. We tend to think of these things as being two distinct channels because we tend to take one piece at a time, and then we would like to tell stories about what is happening. But in fact, they're two sides of the same coin, and that think of the consumer choice problem. You're allocating your scarce own funds across the margins across different assets, and then there are relative price changes that happen in the market. And here, relative price changes mean that there are different increases in the margins. Well, you're going to be reallocating that margin for a fixed budget, and if your budget is if the previous bundle of assets is not feasible anymore, you're going to be switching to the cheaper assets, if you like. So in the case of the asset portfolio, you're going from riskier assets whose margins have blown up to safer assets whose margins are low or have no margins whatsoever. Now, what we do is we go through an example, and in particular, we go through a value at risk constrained long-short hedge fund. And so that's one way of thinking about where these margins come from. So we have a value at risk rule. There's a long-short hedge fund that has to meet margin requirements. And it gives rise to this kind of open jaw chart. So rho here is, if you like, the correlation between two very similar government bonds, or a government bond cash market versus futures. And then what happens when that correlation in the returns becomes very high? Well, of course, you're going to be really increasing your leverage by taking a long position in the high yielding asset, taking a short position in the lower yielding assets. And that's feasible because margins are small. And then what we do is we sort of go through an example where what happens when the correlation changes. There's going to be these shocks where initially you have to reduce your position. This might also change the correlation itself, at least measured by a standard updating rule. And that could create a kind of, an amplification effect that ripples through. Now, in the case of March 2020, what we did see was that margins did rise quite sharply, especially for futures. And this is a chart from the CFTC, where we do see quite a big jump here. And you may have also seen the recent CPMI IOSCO report on margin changes. So let me just skip to, what we do here is just to go through and prove these two propositions. The first one is on the recursive nature of debt. Remember, the idea here is that debt capacity is increasing in the debt capacity of others. And that comes from this idea that, if you have higher margins for one trader and you're holding the assets or you're holding the liabilities of that trader, then of course, by implication, you're holding a much higher leverage vis-a-vis the underlying asset. The second is this idea of the consumer choice problem, just a budget constraint and the prices change. It's just like the substitution effect in consumer choice theory. You go to the cheaper assets. So what are the implications of this? And I think we're going to see Patrick deliver his paper on MMFs next. But we did see this very large divergence between government bond money market funds, which saw huge inflows, and prime money market funds, which actually saw very large outflows. And there was a very similar phenomenon, albeit on a much smaller scale, also in Europe. This divergence. And interestingly, it was the large investors that saw the biggest, saw these biggest, withdrawals, redemptions from the prime money market fund. So controlling for liquidity of the funds and so on. It's very much this idea that this dash for cash is the mirror image of the deleveraging. Same thing with the bond funds. What we see here from a recent bulletin is on the horizontal axis, we're measuring the redemptions, the net redemptions. On the vertical axis, we're measuring the change in the cash position. And the left-hand top quadrant in red is the interesting one, because even as investors were redeeming, the cash holdings were increasing. So in fact, the funds were selling more than was strictly necessary to meet redemptions. There was a dash for cash, even within the mutual fund sector. And of course, we know about the treasury market stress. So let me just conclude with two slides on the lessons. So one idea is, if you have a very protracted period of compressed margins, but then there's a sudden increase in margins, you will definitely enforce lower leverage and hence smaller balance sheets of system participants. And insolvencies, while they would certainly exacerbate stress, are not necessary for stress. You can have stress even in risk-free assets. And instead, it's the pecuniary externalities through prices, spreads, risk measures, etc., that's going to be key. And let me just conclude with one final slide, which is that although it appeared in that very first slide I showed you that the traditional intermediaries were in headlong retreat, actually it's not, that is a very misleading picture, because a lot of the action has migrated to market infrastructures, exchanges, platforms, CCPs, etc. Now, in this context, how would you approach regulation? And I think this recent paper by Metric and Tarullo is a very important one. And they're arguing, well, to the extent that they're performing very much the same economic function, maintaining a congruent approach in the sense of the kind of leverage you can achieve through mix and match leverage, through these other infrastructures, should be broadly in line with the kind of leverage ratio type of constraint that you see in the banking sector. Otherwise, there's going to be this scope for arbitrage, if you like, scope for circumventing some of the regulations. And the congruence both in the cross-section, in this sense, between the banking sector and the non-banks, as well as the smoothing out the time dimension of margins, I think would be a key issue. And of course, what this does raise also, and what I've just shown you is just an accounting framework, but it does also raise the important question, how do the ex-ante incentives change when there are expectations of central bank market operations. So let me finish there.
Super. Thank you. And Antoine is going to discuss.
Yes, as soon as I find my slides. All right, oops, sorry. Okay, so everybody can see the slides. Fantastic. So while I'll be presenting those slides, this is a joint work with Antoine Bouvray and Patrick McCabe. These views are our own, not the institutions we work for, and I will not be talking about monetary policy at all. So this is a very nice paper on a challenging assignment because NBFI is a really broad topic that comprises a lot of heterogeneous institutions. And so the paper does two things. So on the one hand, it provides an excellent overview of some of the main NBFIs, principal trading firms, ETFs, mutual funds, MMFs, hedge funds, CCPs. And you didn't really talk that much about that part of the paper. And then it presents a model of margin spirals and flight to quality. And either of these topics could be an entire chapter. And indeed, the paper is sort of twice as long, I think, as the as an page we were asked to write. So so one question. So one thing that I would have liked the paper to do is integrate those two parts better, and I'll talk a little bit more about that. But I think that Rafet and Jonathan will have to think also perhaps in terms of saving space about whether the paper should focus on only one of those two parts, but both are excellent, and I'll talk a little bit about them. So I'm not going to say a ton about the overview of NBFIs. It's well written, it's informative, it covers a lot of ground. I have a few quibbles. So Yoon presented figure 1. I didn't find that figure super intuitive because it wasn't completely clear to me why, say, PTFs were in the same box as broker-dealers because they do very different things. I think CCPs and platforms are very important, but some of them are doing trading platforms, others are post-trade platforms. I think it would be useful to distinguish them. Anyway, there's other things. So I think it would be nice to sort of think a little bit about how to make that figure more intuitive. I think it would be useful to be clear about what types of risk each of the different types of NBFI introduce. So they're very heterogeneous. I think Yoon and his co-authors focus a lot on the margin issue, which is very important, but there's other risks that they discuss, and I think it would be useful to be clear about that. One example to think about it is the ETF chapter. So it wasn't completely clear whether ETFs are really that big of a risk, and if they are, like what kind of channel the risk come from. So I think it would be useful to discuss that. Perhaps a summary table where the NBFIs are grouped by type of risk would be quite useful because there are more risk than just the margins that we discussed. So let me now turn to the theory. So the model emphasizes central role of leverage fluctuation through changes in margin. I think that makes a lot of sense. That, as you mentioned, there's a recent paper by the BCBS, the CPMI, and IOSCO on margin practices. This is clearly an important topic, and the model has two key results: the fact that debt capacity of an investor is increasing in the debt capacity of other investors, and that spikes in margin can lead to system-wide deleveraging, which resemble flight to quality. So a couple of comments on that. So I think the model applies well to things like broker-dealers and perhaps other institutions, to some extent hedge funds. So clearly leverage and through the use of repo funding is inherent in the model of dealers, even if they are less leveraged than they used to be. I don't think it's inherent in hedge funds. It's perhaps inherent in certain strategies for hedge funds. Perhaps it's something that's more generally about relative value strategies, but there's a lot of other strategies that don't rely to the same extent on leverage. And I would know that the role of hedge funds in the March 2020 events is due to specific factors, right? So hedge funds used to not hold very much treasuries. There's been a huge increase in treasury issuance combined with regulatory constraints on banks that has created price discrepancies that hedge funds can leverage. but it's not inherent in their business model. It's just it's a strategy that arises fairly recently. And leverage doesn't seem to be very important to several NBM5s. So principal trading firms are just not leveraged. They don't hold overnight positions. MMF and mutual funds are typically not leveraged. And in their case, it's really liquidity transformation that seems to be more important. CCPs can contribute to margin changes. That's a very important policy question, but they're not suffering from margin changes themselves. In fact, when increase in margin make the rest of the NBFIs put them in trouble, the CCPs are sort of safer. So I think it would be really useful to. There's some of these elements in the paper, but this is not articulated, I think, quite as well as it could be, and in particular, sort of relating what these different NBFIs do to the model. Doing that better, I think, would help the paper a lot. So I have a couple of quibbles about language. The paper talks a lot about dash for cash in the context of the model, where deleveraging forces a shift of the portfolio weight toward asset categories that are low or zero margin. And as I was reading that, I thought, well, this looks a lot like flight to quality. And so why did we talk about dash for cash in the context of the March 2020 event? So my read of this is that part of the issue was that in March 2020, not only did we have something that looks like flight to quality, we also had massive sell-off in Treasury securities. And Treasury securities are very safe. They're typically a destination of flight to quality flow. So it was useful to have like a different term to distinguish what was happening in this case from what we'd typically seen. In particular, a number of official accounts, foreign central banks, other institutions sold Treasury to acquire cash. So that seems different from a standard flight to quality. But I don't think the model is specific enough to distinguish between the two. So I would encourage the authors to be careful about the language they use and perhaps just make the model more general. This seems to be more generally about flight to quality than specifically about dash for cash. Another minor comment. So as I read the paper and as my co-authors read the paper, it seems like it implies that changes in margins on leverage exposures by NBFI drive liquid demand and exacerbate stress in the system. You could argue that the causality goes the other way. There was a sudden jump in the demand for liquidity due to uncertainty, the pandemic. This leads to volatility in margin calls. It's not a super big deal. In the end, the mechanism describes the paper still contributes to amplifying the stress. But it could be written, I think it's more appropriate to write it with the causality going from a shock to increase in volatility and margins than the other way around. So to sum up, this is a really nice paper that provides an overview of key NBFIs and also presents interesting theoretical results related to margin spirals and flight to quality. There's just a huge amount of ground to cover, and perhaps focusing on a subset of this would be useful. And as I noted, it would be useful to clarify how different NBFI contribute to the economic mechanism described in the paper, in particular to margins, because they don't do so all in the same way. And with that, I'm done.
Excellent. So other comments or questions? Let me take the first chance to ask something. So in a sense, I have a theory of the firm question on the existence of non-bank financial intermediaries. Do we think that these institutions exist solely because of regulation on banks? Or if the regulators were to pack up and leave altogether and said, do whatever finance you want to do, would we end up with universal banks that did everything? We may call them banks or something else. Or would there be a scope? Is there a market-based reason why different jobs are handled by different institutions, and there is a demand for differentiation between, the deposit-taking institution and the hedge fund or whatever you want to call the other ones?
Andreas, would you like to take that on? Thanks, Antoine, for that great discussion, by the way. Andreas, or
yeah,
Cyril,
so I mean, we have a section in the paper where we discuss, I mean, this is on Rafet's question, the drivers of the rise in NBFIs. And you're absolutely right. I mean, oftentimes it's really been changes to regulation. In some cases, it's also a really like a push from the policymaker, for example, for CCPs, I mean, post GFC and so on, for why the CCPs have had so much penetration in the financial system. But then on the other hand, yeah, I mean, some of these entities, they would have also existed for sure without regulation, like bond funds, for example. There I guess we wouldn't see so much of a link to their growth with respect to regulation being a driver and some activities moving away from the banks. It's different for the money market funds, and we will hear that in the next paper, where regulatory arbitrage is the key factor, but I don't think it's the only factor for explaining the growth in NBFIs. And there are others as well, like in particular maybe the changes in demography as well. The role, basically that governments have withdrawn from consumption smoothing, and so more of an effort is actually placed on the management of retirement issues and so on, and therefore basically you have entities that cater to that, and those are not necessarily banks. Let me stop here.
Excellent. Okay, so we're a couple of minutes early. I'm going to take it, and I guess Patrick is going to present, right?
Yes.
And Patrick McCabe, whose expertise on MMFs and hair hasn't changed in the past 20 years, is with us.
Well, thank you, Rafet. Do you see the screen? Cool. Yes. So, well, thank you to you and Jonathan for inviting us here. This has been a pleasure, and it's really been a pleasure to see you and other former colleagues. This has been very enjoyable. So I'll be talking, surprisingly enough, about money market funds. This is work co-authored with Antoine Bouveret at ESMA, Antoine Martin, who just spoke at FRB New York. We have the usual disclaimers. Actually, this work is still preliminary, so we appreciate it if people don't cite or quote it just yet. The views are ours and not necessarily those of the institutions that employ us. And we're not going to talk about monetary policy. See the last disclaimer. Let's see now if the slides move. Yes. So money funds. This is a very successful financial product with over $9 trillion in assets under management worldwide in almost 36 countries, about 1/8 of overall mutual fund assets under management. And importantly, as we just heard, they really operate in a niche between the capital markets and the banking system, where they've taken advantage of regulatory arbitrage. They offer deposit-like features in an investment fund. So as it were, you have a capital markets product with moneyness. But of course, they're also vulnerable to disruptive redemptions and runs, really for the same reason that banks used to be. And that vulnerability arises from liquidity transformation, as well as the fragility of moneyness. Our contribution to this is going to be a global perspective that shows that money fund benefits and vulnerabilities are really evident worldwide. The bank fund niche is quite popular around the world. And this perspective is going to show the generic nature of vulnerabilities. Most research to date has focused on vulnerabilities of money funds in individual jurisdictions with specific rules. And that fosters an industry narrative that the problems and the needed reforms are somewhat narrow. A broader perspective really indicates that the vulnerabilities are much more fundamental. Let's talk first about the success of money funds. We've touched on this. It's regulatory arbitrage, but it's actually not all, this isn't all bad. Some of this, there's really a democratization of access to money market rates here because money funds have been introduced in a variety of countries to allow smaller investors to earn money market rates despite caps on deposit rates. Now, this advantage has largely disappeared as those caps have been removed, and yet money funds continue to be successful. At the same time, they provide larger investors with a relatively safe money-like asset. And this has maybe gotten less attention, but maybe it's more important because money fund shares end up being safer than deposits for many large investors who would face caps on coverage, insurance coverage for their deposits. The origins of money funds kind of reflect the things I've just discussed, and they were invented in the United States, first approved in 1972 by the SEC to give smaller investors access to money market rates. We talked about deposit rate caps. At the time, also, Treasury bill purchases were subject to $10,000 minimum investment. They were really trying to keep retail investors out of these markets. And as such, money funds turned out to be wildly successful. Within 10 years, they're 3/4 of the US mutual fund market. And they ended up playing a key role in interest rate liberalization in the US because banks fought valiantly to get rid of this upstart competitor and only succeeded in getting rid of deposit rate caps. And so you see in the chart here, the red line illustrates money fund assets under management over the years. Look at the gray line, though. That's the share of overall mutual fund assets. And that just goes up very sharply in the late 70s and early 80s until deposit rate caps are lifted. But you see similar stories in France, where money funds are actually created by banks to avoid losing clients when deposit rates are capped. And again, a very large share of mutual fund assets are in money funds within a few years. Go forward 2 decades, and you see a similar story in China. Money funds are also vulnerable. These vulnerable to runs, they can be very disruptive. These vulnerabilities have been studied extensively. As I mentioned earlier, research has mostly focused on features that have worsened runs in individual funds in specific countries. Recent work, in particular by the FSB, actually all 3 of us and Hugh as well were involved in that. All 3 of the co-authors, I guess, it's a little bit of a alum gathering here for this paper. But the FSB spelled out these vulnerabilities a little more clearly. We distill them into 2 main elements that make money funds vulnerable. First, liquidity transformation. And second, the fact that moneyness is fragile. There are other contributing factors like the role of institutional investors, contagion risks, threshold effects. Touch on those in a minute. The role of liquidity transformation in runs is well understood, at least since Diamond and Dybvig. In money funds, though, it's particularly pronounced. And here we're talking mostly about prime funds or non-government funds in other jurisdictions. Many of the instruments that these funds hold, like commercial paper, negotiable CDs, have little or no secondary markets. And it's really interesting that the SEC recognized this problem back in 1975. This is nothing new. Liquidity transformation, though, motivates investors to redeem faster than if they held the instruments directly. So money funds end up contributing to stress because people get out of them faster than they would if they held the instruments directly. Why? Well, because liquidity transformation, as people have long understood, creates a first mover advantage in a run dynamic. But in a money fund, liquidity is free for the first shareholders who redeem. And as such, it's underpriced when liquidity becomes scarce and costly and it gets overused. The second major point here is that moneyness is fragile. Money funds serve, in essence, as private money. In the language of Gary Gorton, Ben Holmstrom, they're information insensitive, no questions asked assets. They are deposit-like with stable share prices, T+0 settlement in some cases. And then sponsor support tends to insulate investors from risk. So this is not really a capital markets model here for these funds. And yet, moneyness and NQA status, as we know, are fragile. It works well until investors do ask questions, and when they do, they rush to redeem. There's some other contributing factors beyond liquidity transformation and moneyness. The role of institutional investors. Just touch on this real quickly, but they have grown as a share of money fund shareholders over the decades, both in the US in the top chart and in France in the bottom. It's a pretty striking shift in ownership. And institutional investors put greater strain than retail investors do, particularly in crises. Put greater strain on the funds than retail investors do. Contagion risk arise because money funds tend to hold the same assets, among other things. And then there are threshold effects, which get a lot of attention. There are discontinuities in the expected payoffs for redeeming investors. It creates an incentive to run preemptively. Some examples of that are NAV rounding and gates that can only apply when weekly liquid assets fall below 30%. It's important to note that money fund vulnerabilities threaten financial stability. Why is that? Well, it's where they operate. They're key intermediaries in the systemically important short-term funding markets. There's an urgency in those markets. This is Holmstrom's language. Stress becomes immediately disruptive because a lot of this market's overnight. If there are problems, you don't have time. You can't wait them out. Money funds also lend mostly to banks in most jurisdictions. Even in the US, where banks are second on the list of sectors that money funds are exposed to, the US government is the first. Much of the lending occurs across borders. And so stress in one jurisdiction can quickly be transmitted to another via money funds. I'm going to go quickly through some examples of crises that have occurred around the world in money funds, and just to illustrate some themes. Interesting case is Japan in 2001, where money management funds with stable 10,000 yen NAVs held Enron debt. Who knew? Losses on that debt led to 58% outflows from the funds in 2 months. So this illustrates the sources of vulnerabilities we've just discussed, the role of liquidity transformation, moneyness. Actually, institutional investors were key here as well. And it also brings up a theme we often see with these crises. You see in the event, official sector, often central bank interventions, and then ex post, the securities regulators trying to close the barn door after the horse is out. They adjust the money fund rules to prevent the last crisis, and then you move forward and you get another crisis. But the key example of that is maybe US in 2008. This is maybe the mother of all money fund runs. After the Lehman bankruptcy, a fund breaks the buck. Really illustrates all sources of money fund vulnerabilities. And here you get very robust, unprecedented responses from the US official sector, not just the central bank, but the Treasury, and then 2 rounds of SEC reforms to try to get things right. China, the story here is actually some of the magnitudes are similar. And again, some of the sources of vulnerability are similar to try to get things right afterwards. And then finally, the COVID crisis. Unlike most earlier crises, the initial impetus here was a liquidity shock. There was a dash for cash that spurred heavy redemptions. But to be sure, this was much more than an indiscriminate dash for cash. So investors redeemed where the risks were greater. There were threshold effects that caused preemptive runs as liquid assets fell. And money funds, as we mentioned briefly in the paper, dumped money market assets faster than other investors did. Again, to illustrate that they exacerbate the problems that are occurring. And the charts here just show the size, the scale of the outflows from US prime and some EU funds. Interestingly here, again, you see official sector interventions, very aggressive Federal Reserve interventions, unprecedented again. I mean, went beyond what happened in 2008, and then the possibility of further reforms is on the plate right now. So I'm going to wrap up with some policy implications discussion, be very brief here. Money funds clearly have a very successful business model in normal times in a niche between the banking and capital market sectors, but they're vulnerable amid financial stress. And the funds have neither bank deposit protections or the ability to disperse risk safely to investors as a mutual fund normally would. So instead, they've relied on support from sponsors, from central banks, and from taxpayers. There are a couple of models that are right off the shelf for addressing these kinds of vulnerabilities. So one is the bank model. That involves deposit insurance, central bank liquidity access, supervision, and so forth. The value added of that approach, though, is a little unclear. We actually already do have banks. There's the mutual fund model where investors ultimately own the risk. So it's dispersed across those who are compensated for taking those risks. Liquidity transformation, though, and moneyness are going to be are going to be hard to address. You're going to need novel policies. Some examples that have been put forward, for example, in the FSB report that I just referred to, are swing pricing, minimum balance at risk, and a capital buffer. We don't get into that much in the paper, but those are some options that are on the table. And there's, of course, some urgency to addressing money fund vulnerabilities as the funds continue, no doubt, to pose risk to financial stability, but also because there are similar challenges emerging elsewhere. And I'd highlight stablecoins, which is very topical as the PWG has just released a report on stablecoins. So that's what I have. Thank you.
Excellent. And Andreas is going to discuss, if you unshare.
Oh, I'm sorry. Yep.
Very good.
All right. Can you see this?
Yes.
Well, if that is your discussion, yes.
Yeah, wonderful. All right. So thank you very much. It's been a great pleasure to read this paper and to discuss it. Also compliments to Jonathan and Refat for really picking the top experts on this topic. And Patrick already brought it across. All the three were essentially involved in some of the policy work also just after the COVID crisis to make the money market fund safer, in particular the FSB work, where they were all in lead roles. And Yun was actually the chair of the working group together with a counterpart at the SEC. So what was great to see was especially that this international cooperation was bearing some fruit. What I really like about the paper that Patrick presented is really also the international side and the historical context that the authors give us. He didn't really show it in the presentation, but there's a lot of really interesting things also from less known markets like in South Africa and so on, and they strengthen the overall narrative and sort of insights when it comes to the vulnerabilities of the money market funds. So in my discussion, I want to focus on four things. First of all, the key money market fund characteristics that give rise to financial stability risks. Patrick discussed it already to some extent. I have some points on that. Then the international dimension and spillovers, the role of the investor base, and then money market fund substitutes. Let me turn to the money market fund.
Andreas, before you go on, may I interrupt you for a second and say your camera is turned off, and if it's intentional, it's just fine. I just want to tell you.
Okay.
We see your slides, but not you.
Sorry. Maybe I just need to return. All right.
Now we neither see you nor your slides.
Can you see the slides?
I give up. We see the slides, and I'm happy with that. Go ahead.
All right. Okay. Good. So I think what I will switch on the camera later on. I just forgot it to have it on when I shared. So what Patrick nicely brought across is that money market funds really occupy this niche between a cash product akin to bank deposits and being an investment product, more like a bond mutual fund. And I would also say, I mean, when it comes to the vulnerabilities, that I've listed them here as they have been discussed in the paper. So liquidity mismatch, clearly that is well studied and well known. The other aspect is the creation of a private near money asset that can switch to become informationally sensitive, but for most of the time isn't. So I guess these are quite well known, and we know also from the literature that they give rise to first mover advantage and run risk. What Patrick and his co-authors add to the list of vulnerabilities is the dominance of institutional investors, which gives rise to fleetiness, that they typically put a lot of strains, liquidity strains on the funds, and investor concentration, the similarities of portfolios that give rise to contagion effects, and then threshold effects, like what we also saw during the COVID crisis with the weekly liquidity thresholds. Now, what I wanted to point out is it's worth maybe discussing a little bit more how these more subordinate vulnerabilities, how they're basically linked also to the core vulnerabilities. So in particular for investor concentration, I mean, when you try to move to reduce the liquidity mismatch in the funds, or to basically reduce the near money asset feature of the funds, basically by restricting the investment universe, shortening maturities, in raising the quality of the paper and so on. Isn't it by construction that you also get greater investor concentration, similarities of portfolios, and hence contagion? So there seems to be an interlinkage or some trade-off basically between these different vulnerabilities and how you would address them. So let me turn to the international dimension and spillovers, and this gets also to the question of why do we care about the stresses in money market funds? I mean, in the paper, there's a discussion that money market funds often serve as a funding vehicle for foreign banks, in particular when they lack a deposit base in the respective currency. And this is especially the case for the US dollar, but it's not only for the dollar, it's also like this for the pound sterling, for instance. But through this link, we often have these international effects. So whenever there's a crisis in US or some other money market fund segment, it really spills over as a funding shock around the world. FX swap markets in particular typically need to take the brunt as the funding gets replaced. And this brings in also the crucial role of liquidity line agreements, as similar to one of the earlier papers. I think what would be beneficial is if the paper discussed these aspects a little bit in more depth, because it really also gets at the question of why do we care? And another issue there is that typically the stresses in core funding markets, they also hamper the monetary policy transmission itself during the crisis. One key reason there being that the CP and CD markets, they're basically an input into LIBOR submissions, and hence, because there's so much of contracts and activity underpinned by LIBOR, there are spillovers that transmit to the entire world. So there's an open question whether the risk-free rates like SOFR and the shift to those will mitigate some of these issues, but it's not fully clear because there's still also credit-sensitive rates that are being employed and things like that. So I think some better discussion of these aspects would and the international interlinkages in particular would be quite beneficial in the paper. The other thing that would be beneficial is to just have a summary table with some of the key MMF features across countries, and perhaps also some data on their respective footprints, because that would allow us to have more of a synthesis. Right now, all these things are discussed a bit in parallel and not much integrated with each other. Let me now turn to the investor base. So Patrick has mentioned that the retail versus institutional distinction is an important one, and it also underpins some of the regulatory approaches, with regulation for prime institutional funds being much tighter than for retail funds in particular. But there is also some more to this, and in particular, the composition in the institutional investor base can also give rise to vulnerabilities, in that some institutional investors, in particular, the larger ones, may be even more fleety than others. And especially so also if they need to sell MOS shares to meet margin calls, for instance. And this is essentially one thing that came out in a paper by Avalos and Shah. Jun had it also in his slides. So basically, here you can see that during the COVID crisis, the large institutional investors, they basically pulled out from the money market funds, from the prime institutional money market funds, quite irrespective of the liquidity positions of the funds. Whereas for smaller institutional investors, there was some differentiation, but still for the large institutional investors that really dominated and created the biggest pressure. The flows were quite indiscriminate of the liquidity positions of the funds. The final point that I wanted to raise is about money market fund substitutes. The prime money market fund industry certainly no longer has the heft that it used to have. I mean, this was a much bigger industry, but still the financing needs, they have not decreased. So it's a general question of in which structures are the CPs and CDs issued by these corporates and banks are held. Are these structures generally safer, or do we also see vulnerabilities in this area? And there is some empirical research that the authors have added over the last few days to speak to this question. But I think that would still warrant a bit more discussion. I mean, what are really the money market fund substitutes? Because this sector is quite opaque. And then related to this, Patrick brought it up, but I would just like to amplify it further, is indeed the growth of stablecoins. Money market funds for a long time have been a problem child in the financial system. Now, however, with stablecoins, they resemble money market funds in a lot of ways. And so this could be a new problem child. And so overall, my suggestion would be to give greater in-depth discussion of money market fund substitutes. And just to further amplify, I mean, there have been some disclosures about Tether's reserve holdings, and some estimates by industry suggest that they have now overtaken a lot of the usual suspects of holders of CP. So Tether has now become one of the largest holders of commercial paper, but it's quite unclear what quality that paper has. And it's unregulated, so something to worry about. So just to wrap up, it's a very informative paper, provides a great synthesis, and I would generally highly recommend reading it. That's it from me.
Excellent, thank you. Before I turn it to the floor discussion, yes, I have to say, given every paper or every presentation discussion ending with reference to stable coins or crypto something or central bank digital currencies, and I see Jonathan nodding there. Hopefully this whole thing is going to die very soon, so that we're not going to look like the guys who missed the turning point and edited the handbook on financial markets without realizing that this was the thing to put in there. But Yanshin has his hand up, so.
Great paper, Patrick. It's also great to have the FSB report alumni on the call. I see. It brings back very happy memories. Just to underline, Andreas's point about the systemic dimension. I mean, it's worth, Patrick, also pointing out that even for the US prime money market funds, it's the non-US banks who are borrowing there rather than US banks. As a rule of thumb, 50% of the prime money market fund assets in the US are, the liabilities of non-US banks. And the other issue is you haven't really spent that much time on the government money market funds, but there will be, of course, very important point of contact. And just going back to my presentation, it's the repo based on government security collateral, which is a very important asset in the government money market fund. So just because they are not vulnerable to redemption, it doesn't mean they don't have systemic impact. So I think that aspect probably needs to be underscored a bit more, especially in that's become a huge part of the market. It's by far the biggest part of the market. But great paper.
And Bill?
So I thought the paper was terrific. I really enjoyed it. I did have one issue that wasn't raised, I think, unless I missed it, but which I remember Patrick talking with you about at some length at various points, is the ability, at least of U.S. money market funds, to handle negative interest rates, and that was a constraint on monetary policy at times, I think, because if you wanted to consider negative rates, you had to deal with what that would do to money market mutual funds, and yet in the euro area, money market funds seem to be able to make that transition. Maybe they could have in the US too, but anyway, maybe it's just a brief discussion. But I think that fragility was at times something that people were worrying about, and it might be worth a little discussion.
Super. Would the authors like to take a minute?
So just a couple of quick thoughts. I thought all of those comments were great. I mean, they're all on target. There are things that we just didn't cover as much as we would have liked. The government fund one is, which is actually related very closely to what Bill just mentioned, the negative rates. I think I'll not comment on the latter, but that's a big issue that we didn't really take on directly. We focused really implicitly on the prime funds. The cross-border discussion, of course, we did bring that up. We didn't go into it. Given the global focus of the paper, it might be helpful to expand on that a bunch. I guess I'll just plead to the editors for space. I'll leave it at that. But I really enjoyed the comments. Thank you.
All right, excellent. And on time. So we are off for lunch or dinner, depending on where you are. And today we have a more civilized full hour for a break. So we'll be back 1:30, whatever hour is the next hour for you. And we'll be back with munis, sovereign debt, equities, and futures and options. So looking